am Professor Leandra Lederman from Indiana University Maurer School of Law in Bloomington, and I run this tax policy colloquium, which, as I mentioned, is in part a class for students. And I'm thrilled to have here today to speak to us on his work in progress, Dan Shaviro, who's the Wayne Perry Professor of Taxation at my alma mater, NYU Law School. And he's a leading legal scholar on tax policy, a graduate of Princeton University and Yale Law School. Before entering law teaching, he spent 3 years in practice at Kaplan and Drysdale, a leading tax specialty firm, and 3 years as legislation attorney at the Joint Congressional Committee on Taxation, where he worked exclusively on the Tax Reform Act of 1986. In 1987, he began his teaching career at the University of Chicago Law School, and he joined NYU School of Law in 1995. His scholarly work examines tax policy, budget policy, and entitlements issues. He's published numerous books and articles, and he's also published a novel, Getting It, published in 2010. And at NYU—
999 Kindle.
Terrific. And at NYU, he teaches various tax courses, including a colloquium similar to this one on tax policy and public finance. And today he'll be speaking to us on what are minimum taxes and why might one favor or disfavor them. So go ahead, Dan. Thank you.
So great. So, and everyone can see the slides, right? Huh. Oh, I have to go back. So hold on. So, this is an article that kind of comes full circle to me. I thought of writing it first when I was at the National Tax Association conference in November, and there's all this talk about how minimum taxes, is mainly in the global context, would be like a great idea. And I was thinking, including intelligent, knowledgeable people were saying this, and I was thinking, I remember minimum taxes, and I didn't think they were so great the first time. So what are they, and why are people so excited about them this time? So as per the slide, I was at the Joint Committee on Tax from 84 to 87. I worked on the Tax Reform Act, and one of the biggest things I worked on in terms of how much of my time it took was designing the AMT. We created, there was kind of a minimum tax before, but we created an AMT as a full alternative system to the regular system. It took a lot of work and ingenuity by a large collegial staff, and it was kind of exciting and fun. The other main thing I worked on when I was there probably was the passive loss rules. Anyway, I graduated with my job talk when I got hired to go into law teaching starting in 87, was for what became my first academic article, Perception, Reality, and Strategy, the new, I'm sorry, I want to put this on my other screen so I can see the whole screen. Anyway, sorry about that. But so I gave a job talk on this, and I wrote an article about it. And even though I had worked on the AMT, and you know, lawyers like to believe what they're doing, and I was kind of excited and proud by the efforts our staff had made to make it work, I had enough perspective to be very critical of it as an instrument and to think it didn't really make much sense, and that a lot of the arguments for it, including arguments I was involved in writing up in the committee report, including paragraphs I had written, but I was, as they say, only following orders, that these things didn't really make sense. So I wrote this article in the AMT, and then a year or two later, I wrote an article called Selective Limitations and Tax Benefits, which was kind of talking about things like passive loss rules, but sort of, I saw similarities, commonalities. So I'd been like doing this stuff. Then the AMT, that kind of disappeared. The passive loss rules moved into the background. So this was like my first set of academic ideas to write about it in this thing, and they went away, and that was fine with me. I was happy to write about new things. But then I find minimum taxes being back in vogue. And as we'll discuss, the BEAT is a minimum tax, GILTI is a minimum tax. Vice President Biden has a book income taxation proposal that would be a minimum tax. And the OECD has so-called Globe Pillar 2. They're talking about global minimum taxes. So I was thinking, what's the deal with these things? So my first kind of movie references from Naked Gun 2.5, Frank Drebin is back, just accept it. And so that's kind of the way I feel about it. But that even if you just have to accept it, what are the lessons learned from the first time around? Then my second thought is from another movie, I guess Godfather 3, just when I thought I was out, they pull me back in. And here it's I think sort of the minimum tax idea is kind of dumb, to use a very refined academic word, but I really know about this. I've thought about this issue because it was like the start of my career. I spent a lot of time on this, so I thought I've got to have something to contribute on this. And in addition, for the global part, I thought my work on foreign tax credits and what I call the marginal reimbursement rate for foreign taxes, I thought that was highly relevant. So I thought I'm sort of ideally situated to write about this because I've sort of been there. I've kind of been required in the past to think about all these issues. So it's, so I can start from kind of having my feet already in the water. So it was kind of fun to kind of go back to these things. I would have gotten intensely bored if I'd spent the last 30 years just doing them, but it was kind of fun to go back to some of this stuff. So I had to think a lot about what is a minimum tax for starters. And I come up with a bunch of different definitions in the paper. Purposively, think of it as you have the current year quote regular tax law, your regular tax which has preferences in it and other shortcomings. The notion is that you should pay at least some minimum amount this year of your true income in tax, not just your taxable income, your sort of true income. So the AMT approaches this. The way the AMT works is you broaden the base by denying income tax preferences, and you have a larger base and in typical year, a larger income amount. Then you have to pay tax on that at a lower rate, but you only pay the greater of the two. So you pay the minimum tax. It's the least you can pay under the regular tax. You top up to it, but it doesn't apply otherwise. And then one thing that the beat has brought to my attention is, though not uniquely so, is that to say the base is broader is not just to say the same that it's expanded. So for example, if we had a Haig-Simons income tax and then we changed it by making it a tax on gross income or gross receipts by denying deductions, that would be a larger base, but it wouldn't be base broadening in the sense in which it's used, because it would be going beyond the quote normative measure. So to say you're broadening the base isn't just saying it's bigger, but that you're moving towards a normative thing. And of course, that can be in many cases disputable, like our state and local income tax deductions, where do they fit into that? And that's particularly relevant into the BEAT because of so-called base erosion tax benefits. We'll talk about it a little later. The BEAT in some respects taxes gross income rather than net income, although there are rationales for that. Anyway, a little different is global minimum tax. There, rather than kind of having broadening the base, so to speak, you have you have foreign source income, and the national rate on the foreign source income can't be less than 0%, as it would be, for example, with the refundable foreign tax credits. The national rate of tax has to be at least 0, but the global rate has to be at least some minimum amount. And so if the other countries aren't charging enough, then you top up on a residence basis to your companies. So in a global minimum tax, what's happening is that the global rate on foreign source income has to equal at least some minimum percentage, and you're going to charge that yourself if other countries don't, but you're not going to have a negative rate. For example, if other countries charge a company above that minimum rate, they don't get a refund. The companies don't get a refund from you. So it's kind of a minimum, there's a minimum rate of whatever the percentage is for global tax liability, and for national, the minimum rate is 0, or it can be positive. It'll be the full minimum rate if other countries aren't levying tax at all. So that's sort of it's kind of base broadening to have a minimum, and I compare it to, I say it's really something which people who are into income taxation, as compared to say consumption taxation, are going to be especially into, because income tax is an annual measure. And once you're thinking in terms of an annual measure, you're possibly going to be inclined. This really has nothing to do with the fundamental income versus consumption tax question of whether the return to weighting should be taxed or not. But when you're kind of in the model of thinking annually, is things that happen annually, that's key, then you're naturally going to be more inclined than otherwise perhaps to think in terms of a minimum rate being paid this year. So anyway, what's a minimum tax? Technically, you have two distinct computations and you pay the greater of the two. If we had Joe Biden's book income minimum tax, the idea would be that it's sort of a broader base than the income tax. It's a different base, it's just computed differently, but the notion is that it's often larger because it's closer to reality. That's the rationale for it. Obviously, we could dispute how true that is. Then, of course, with the BEAT, there's the question of whether the base is broader or just larger. In the global minimum tax, and I had to, as I was writing the paper, I had to figure out why they are minimum taxes. One, why people call them minimum taxes, and two, why there's sort of a reason to do that. There, the notion, if you kind of think of it, you can kind of think of it as still being a foreign tax credit system, because you have some minimum rate, but you can satisfy it by paying other sovereigns rather than your own sovereign. So that's sort of like having foreign tax credits, but viewing them as a tax preference, except one that goes to since the credit goes to the liability computation rather than the base computation. So fairly similar, except raise all the issues of why does a foreign tax paid to a foreign sovereign matter. Finally, what is a minimum tax semantically? And I point out that the pre-2017 US system sort of was a global minimum tax. Because of the 35% rate on foreign source income and the allowance of foreign tax credits, it required that you to pay at least a minimum 35% rate globally. And because of foreign tax credit limitations, it said the rate couldn't go below zero. The US rate couldn't go below zero, as it would have on foreign source income, as it would have if foreign tax credits were refundable. Now, it's true that the pre-2017 system didn't try to measure, quote, economic income, foreign source income in an economic income sense, used deferral, so that profits earned by subsidiaries abroad would not be taxed in the US absent certain special categories until they were repatriated. But nonetheless, it was using the same income measure for both purposes. In other words, to figure out both the 35% global rate, the FSI, foreign source income, which you had to pay 35% globally, and zero, no more less than zero domestically, was kind of calculated the same way. So why wasn't it called a minimum tax? And I think there are two reasons. The national 0% rate was, I talk about this in the paper, was just viewed as kind of a natural limit. It's the same I talk in the paper about non-refundability. If you have negative taxable income, you don't get a net refund for the year other than through NOLs against other years. So 0% was kind of viewed as a natural limit rather than as a choice. It really is a choice to say we're not going to have a negative tax rate. And in the global area, it's just that although it's true that the US in fact established a 35% minimum rate on US companies' foreign global rate and minimum US companies' foreign source income, taking as given that it was measured subject to deferral, they weren't really thinking in global terms. They were kind of thinking, what's fair for our companies? It's not fair for our companies to be double taxed. So globally, it just wasn't thought of that way because that wasn't the focus. But nonetheless, it was saying you have a 35% minimum global rate once something is entered into the computation of US computation of foreign source income. So the Obama administration did something, a budget proposal that I think my colleague Lily Batchelder worked on. They were going to lower the corporate rate to 28% as part of the same reform. They were also going to have a 19% global minimum tax, and they called it a minimum tax. And they also had only an 85% what I call marginal reimbursement rate. In other words, you could only offset $1 of foreign taxes paid, only 85 cents of it offset the required 19% rate. So as a result, what I say in the paper I think I can defend is that in a way it was less of a minimum tax than the prior regime, because it gave only 85% credit for foreign taxes paid. So if you paid a lot of foreign taxes, you actually had to pay more on a worldwide basis. It didn't offset US tax liability in the residual dollar for dollar. But it was called a minimum tax, whereas prior law wasn't. And I think having a different rate for foreign source income than for domestic, although sort of semantically irrelevant, it made clear what the purpose was, that they were thinking in terms of a global rate rather than just thinking more solipsistically like the original foreign tax credit thinking. Now, why does the use of a minimum tax matter? And here's where the David Gammage shout out is about to come. I realized something I was saying seemed to contradict something David had said that I agree with, but it didn't really. So I had an unpleasant run in early in my career with this famous kind of pop philosopher named Mortimer Adler, who came to University of Chicago Law School, and no one showed up for his lecture because I didn't tell my students they had to. I said, show up if you want. And so none of them did. But Mortimer Adler famously gave a lecture. I know you've seen the joke, I guess, in the paper. He famously gave a talk called 6 Proofs of the Existence of God at the University of Chicago Law School before I got there. Supposedly after proof number 1, someone raised his hand and said, Mortimer, if that proof is so great, why do you need the other 5? My thought is the same thing with minimum tax. If you have, if the regular tax is so great, why do you need the minimum tax base? Then I thought of the point that David Gammage has made, and that, which it doesn't contradict this at all. It's something else, which is that David makes the point, you might want to have 17 or 30 or 2 or some number of separate tax bases and they all apply. So you have, for example, a low rate consumption tax and a low rate income tax, and both of those could have different versions, and you might have a wage tax. His point is that, you'd have all these different tax bases. But the thing is, in the vision he has and that all of us have when we think about this issue, they all are separate tax systems and they basically all apply separately. So in a sense, there is one tax system that's simply the combination of them all. And his rationale for that, of course, is to lower the distortion, the overall distortion, because it grows, geometrically rather than linearly at any one tax base. So that's not the problem. It's not having multiple tax bases. It's kind of saying once you have the whole thing that works, now you have this second thing that only applies conditionally. If the main thing you have is going so well, why do you need this other thing that only applies where you pay a tax conditionally and not paying enough under some other tax? And it leads to some odd consequences that seem all else equal undesirable that I discussed in the paper. You get distinct tax clienteles, and you get arbitrarily discontinuous marginal incentives. And both of those things don't seem to make sense. The tax clientele is a familiar point from the foreign tax credit, where it was well understood by international tax lawyers and economists that companies that could benefit from foreign tax credits in the margin versus that couldn't had basically fundamentally different incentives about where they'd invest. They also had reasons to try to play games to kind of have the the low tax and the high tax things be exactly balanced with each other, just like under the AMT. I have an example where you want to have just enough taxable versus tax favored, regular tax favored assets. You get arbitrarily discontinuous marginal incentives, where a company, it'll save $1 per dollar paid, and then all of a sudden it'll save only 70 cents per dollar paid, and so forth. So you get these odd features, and the marginal treatment of an item isn't determined by itself. It depends on the quantitative relationship between it and other items. I know that's said fairly abstractly, but hopefully in the paper I grounded a little more. Anyway, and I say, if such relationships don't yield relevant information, if they don't tell you about how much someone should pay, then it's absurd that they should have a tax effect. On the other hand, if they do yield relevant information, you don't need a minimum tax structure. And let me give an example of that. An example is suppose that you believe, and there are people who have argued this, I think I'm one of them, that the relationship between taxable income and your financial accounting or book income, the book tax gap, if the book income is greater, that is of normative interest. In other words, if the book tax gap is high, there might be reason to believe you're playing games with your taxes and actually also with your financial accounting. So both financial accountants and tax and the IRS might be interested both in the book tax gap, but a book income minimum tax would in fact sort of use something about the relationship between the two, but it still does it in an odd way that gets the clienteles and arbitrarily discontinuous marginal incentives. You could just look directly at the book tax gap and assign positive and negative tax consequences to that. So very often the relationship between the two, the relationship between different items on the taxpayer's overall portfolio that gives rise to a minimum tax liability or not, one, it often does not really yield relevant information about true income or how much you should want the person to pay. And when it does, you don't have to have a minimum tax structure with all those discontinuities to take advantage of it. So I kind of do, especially a case study for the AMT, because that's the one that's actually happened. I'm kind of ask, what do we learn from this? And one of the things we learn is that an AMT does not necessarily, if the rationale for it in 88, when I wrote about this, I said the best rationale for it is that it is a way of reducing the use of tax preferences if you think tax preferences are bad. But it may not have that effect depending on how things work out in the marketplace if taxpayers simply reallocate. You kind of, the tax preferences are transferred from taxpayers that can use them in full to those that can't, or you have mergers between high tax and low tax industry companies. But I do note that for some, it's truer of some items than other. For example, putting depreciation, accelerated depreciation in the AMT is kind of naturally going to be countered by reallocating who owns which assets. But on the other hand, SALT deductions, state and local income tax deductions for individuals, leaving aside the question of whether that is, quote, a tax preference or not, if you want to limit it, it's admittedly true, that I'm going to have sort of a harder time if there's an AMT which denies the state and local income tax deduction. It's going to be harder for me as an individual to maneuver that the same way, because I probably don't want to live 30% in New York and 70% in Iowa, with all due respect, and so forth. So it kind of varies on how what type of revenues they are. I also, a lot of the case for the AMT was optical. My research assistant agreed I was allowed to not have a cite for saying that I was in the gosh darn room when Russell Long said, "Just 1 cent. I just wanted to pay just 1 cent." Sorry, I had to do that. Anyway, I talk in that paper I wrote 30 years ago. It's kind of bizarre. It's as bizarre as the photo of me, which is me 30 years ago. But also, if you look it up, but also reading myself 30 years ago, it's kind of, it is me, but it's not me, because I've changed. Anyway, it's sort of, I express unease there about pursuing optics for its own sake, which is the thing. We have to make people believe the system is fair. And I talk about both the mixed motives why government officials might have for doing that and how it's definitely mixed good. One thing we also learned from the AMT is the political economy playout may be changeable. There are some ways the AMT really worked well as a political economy matter in '86, but it worked poorly later on. By the way, I think I'm getting hoarse here because I haven't talked to anyone but my wife for about 3 weeks. Anyway, and then finally, with apologies for this, today's vaccine may not fit tomorrow's virus. That is probably not a good metaphor, or too on the nose to use today. But the point I have in mind there is that the '86 AMT was not badly designed in some ways to prevent tax avoidance from taking place by the mechanisms of that era, but it was not rightly designed and discussed in the paper. It wasn't responsive to the way tax avoidance has been going on since the late '90s on. Oh, if anyone hears me yelling, one of my cats is here, wants to know what I'm doing. Hey, Gary. I'm tempted to pick up my cat, but I'm afraid I'll knock everything over. Hey, baby. Anyway, so that's sort of the AMT. With regard to book income, I don't want to make this an article about whether we should tax book income or not, because that's a whole separate subject. I'm kind of interested in, if we're doing that, should we do it through a minimum tax, which is the Biden proposal, or as Elizabeth Warren would have done it, as a standalone instrument. And there are a bunch of arguments. I have them on the slide in the paper about why you might want to tax book income. There are also a bunch of arguments about why you might not want to. By what I mean by, say, orthogonal on the slide is simply that, some accountants point out, financial and taxable income, they're different measures. They're done for different reasons. The fact that something's in book income doesn't necessarily tell you the things you want to know about the person, how much tax the company should pay. There is concern that having tax consequences assigned to book income. Okay, I'm going to do it. Here he is. This is Gary. Anyway, there are arguments that companies will be less transparent. There'll be loss of information to the market if you tax it, and also Congress will interfere more. So the only reason I can see, I talk about this in the paper, the only reason I can see for doing book income as a minimum tax is either for optical reasons, if you accept that set of views, which I'm a bit skeptical of, although I don't think they're quite provably wrong. And in addition, if you don't like the book income minimum tax, then maybe make it minimum tax, you kind of hobble it enough. And if the effects it has are bad, then maybe it's worth the weird side effects to have it be less, to kind of have it not matter much of the time, which would be either cynical or counsel of desperation. There are a lot of problems I just talk in the paper with doing it as a minimum tax. You create different clienteles, you create discontinuous incentives in both tax and financial, and you have to handle annual swings between the systems. And I mentioned in the paper that you have the classic case where, and we worried about this for the AMT in '86, where in 1 year the thing is, you close a factory and that's $1 billion loss. It's written off in 1 year for the regular tax, for tax purposes, different year for book income purposes. So each time you write it off into one system, you end up in the other system, and you kind of never get to deduct it, in effect. So you really need an adjustment for annual swings. That problem is less bad if you have book income as a standalone. You still have problems under the Warren proposal of book gain 1 year, book loss another, or since she had an exemption amount, kind of being under the exemption numbers over, but you make the annual swings between the systems a lot trickier once you make it a minimum tax. And finally, given the argument that the tax book gap is itself informative and therefore it provides information about tax avoidance or something that you don't like, do you want to assign tax consequences to? That shows the possibility that you would want to assign tax consequences to the tax book gap, although that brings you back into all these arguments, but doing so doesn't require a minimum tax structure. For example, you could have a symmetric part-way adjustment from taxable income towards book income. That wouldn't lead in a completely flat rate system. That would be a sort of continuous response. Anyway, on to the BEAT. So the BEAT is technically a minimum tax. You have a 21% corporate rate, then you add back base erosion tax benefits, which are basically any deductible payments made to foreign affiliates. And that gives you a larger base, and that's taxed at 10%, but you pay the greater of the two. And of course, that's overkill. It implies that you should have, you should always deduct zero to affiliates, whereas as long as you're having separate country accounting and all that, it implies that all the income is in your gross income. It's sort of taxing gross income of the group in some respects in one country. So it's a clear overreach, but it's responsive, of course, to the concern that allowing the deductions leads to underreach, both because of transfer pricing games and because of concentrating deductions in high tax affiliates. So I think most even BEAT fans would agree that making the BEAT into the regular tax wouldn't really make sense, because we would have elements of being a gross income tax. So even if they could argue that it's better than the existing tax because the overmeasurement is less than current undermeasurement, I'm not saying that's true, I'm just saying it could be argued, but they'd have to agree that that would sort of be inappropriate. It would be like taxing gross income. Also, if you think of the BEAT as ensuring that the company pays at least some minimum rate on its true US income, then you need a true income measure, which you don't have here. So it doesn't kind of have that rationale either. So what I think of the BEAT as doing is saying we have an excise tax on base erosion tax benefits. The excise tax rate is zero as long as you're in the regular tax. As soon as you get onto the BEAT, it's a 21% excise tax that offsets the 21% regular tax deduction. And as I sit here right now, I'm wondering, is the arithmetic right? And I'm pretty sure it is, but that's in the paper. 21, not 10. Anyway, so it's like a two-tier excise tax on base erosion tax benefits. I think that's the right way to think about it. It's unclear why we'd want such a structure. And the conclusion I reach is that if you like the BEAT type of approach, and again, just like should we tax book income, that's kind of separate, then you really should be thinking expressly in excise tax terms, and think about having maybe a low rate excise tax. You could imagine being burden neutral or revenue neutral to the existing system. And you could also apply it not only to base erosion tax benefits, but also related items that the current system admits. For example, the current system doesn't count cost of goods sold from intergroup transactions, which leads to a silly avoidance trick, which is that you, instead of paying a royalty to your foreign affiliate, you have it embedded in an inventory item you buy from it. So you could kind of put a whole bunch of things in there, lower the rate, and it would kind of be, not to say it would be a good instrument, but it seems like it would probably be better than the BEAT because it would be more continuous and have less of these bizarre internal incentives that the minimum tax structure leads to. Okay, turning to global minimum taxes, again, the US sort of had one, although not by that name, pre-2017, although computed based on deferral, using deferral for foreign source income. And as I mentioned in the paper, that's some very important effects. It meant, for example, that even though foreign taxes were fully creditable, which in theory could create zero cost consciousness by a US company with regard to its foreign tax liabilities. Oh, Gary is back. A lot of companies acted like they were foreign tax cost conscious because they didn't anticipate ever repatriating the funds while the current US repatriation rate was on the books. Anyway, so the Obama proposal made it less of a pure minimum tax since foreign taxes are only 85% creditable. Nonetheless, it was called the minimum tax. And then GILTI passes. And GILTI is, roughly speaking, the same thing. It's different in a number of ways. There are a number of quite important differences. And one of them is that it's not country by country, it's a global system. So it kind of raises similar sets of issues. The OECT's GLOBE proposal is also apparently likely to be similar. It's very underspecified because they just issued it in a somewhat, not the most beautifully literary document ever written, but it's sort of a guidelines for how countries should proceed. They seem to anticipate, in effect, a 100% foreign tax credit, but that could actually make sense if you imagine it being multilaterally adopted by everyone. And also, they have a lot of problems they have to deal with that the US didn't face simply because they're thinking of multiple countries with multiple tax systems adopting it. So you get into a bunch of technical challenges and policy challenges too that the U.S. doesn't face when it passes guilty. Nonetheless, one of the things I say in the paper is really why would you do this minimum tax structure? Suppose with a 100% foreign tax credits, why is that the structure that a country would use? So I think that's a question of marginal reimbursement rate. Again, under a pure foreign tax credit system, you pay $1 foreign taxes, you reduce your domestic taxes by a full $1. So that's a 100% marginal reimbursement rate. As compared to a deduction, if foreign taxes were, say, deductible, not to say those are the only two choices, then the marginal reimbursement rate would be the same as the marginal tax rate, because if by deducting $1, you reduce domestic tax liability by the $1 times the rate. Anyway, so how should countries think about the right way to credit or not credit to reduce domestic liability by reason of foreign taxes paid? And this is something I've written about before, so it's kind of easy for me to plug it in here. The simple story is that we get the money when it's our taxes. We don't get the money when it's your taxes. Therefore, $1 foreign tax paid is no different than anything else, like $1 of rent, etc. So the marginal reimbursement rate should equal the marginal tax rate. Foreign taxes should just be deductible. And if foreign source income is exempt, that means that there's a 0% reimbursement rate. That's the simple story. The more complicated story, and this is still a country acting unilaterally, by which I mean that no other country is going to change their tax rules by reason of what you do. We see kind of globally anti-tax haven rules, which suggest that countries are unhappy when they observe their multinationals paying very low foreign taxes or zero foreign taxes. And I think the story is that the explanation is that they consider that basically a marker of something bad going on. In principle, it should be fine for your nationals not to pay foreign countries' taxes, but if they're not paying tax to anyone, this implies they might be profit shifting at the expense of the domestic tax base as well. So I've written about this a bit, and I have a story about that international tax being like it is maybe disputed by some other people. But the basic idea is that you may actually be averse to observing tax haven income, or foreign source income that's paying like no or very low tax rate. You may want to tax it more. And the reason in a unilateral story, in a unilateral and selfish story, is that you think something fishy is going on, which involves excessive profit shifting at the expense of your tax base. And that is why I think countries do it. As soon as you get into strategic considerations, you can get higher MRRs. We're nice to your taxes, to payments of your taxes, because you're nice to payments of our taxes. So that story, that strategic story, can get you higher. And indeed, it can definitely get you to 100% reimbursement if you have two identical countries that are kind of reciprocally doing exactly the same thing. But when you have a lot of exemption countries that are not crediting foreign taxes, it's going to be pretty hard to get your optimal marginal reimbursement rate close to 100% unless there really is very full reciprocity between sufficiently similar countries. So I call watch of the marginal reimbursement rate, I call that a Goldilocks problem in some of the stuff I've written. And that's, I have to admire the little girl from the Three Bears fairy tale. She knows what's too hot, too cold, and just right. But one of the big problems in international tax policy, well, it's raining. I can hear it in I don't know if it's affecting my audio. One of the big problems is, unlike Goldilocks, we don't know what's just right. If you think the marginal reimbursement rate for foreign tax should be less than 100%, that's too hot. It should be higher than the marginal tax rate, such as 0, that's too low. All you have to do is get it just right, but that's very hard to solve. Anyway, sorry, I'm doing this just so I can see the full screen. Anyway, global minimum taxes given MRR issues. It's not clear to me why this is the way you do it. Even if you regard foreign taxes paid as relevant for both unilateral and strategic reasons, why would you set it up in the minimum tax way? It just doesn't really follow from the logic of either unilateral or strategic determination of MRRs, again, unless you have a very full reciprocity story going on. Another thing I want to address here is there's this longstanding dispute about whether foreign tax credits or minimum tax systems should be per country, like the Obama administration proposal and like US tax law at one narrow band of time, or whether it should be worldwide, where you're able to average high tax against low tax countries. The conclusion I kind of come to is that structurally per country makes more sense because you get into all these silly minimum tax, the amount of one item depending on other items here, balancing far high tax versus low tax countries. So structurally, per country sort of makes more sense than worldwide, subject to some drawbacks. It's more complicated. There's some examples where it leads to perverse results. It's an old and familiar debate. But what I want to take out of the debate for my purpose is the fact that all the people who like per country like it because it's tougher. All the people who like worldwide like it because it's less tough. They don't want the companies to be hit as hard. But the thing is, the degree of rigor is really, in principle, separate from the structural question. You could actually take a per country system and have the rate be lower, or a worldwide system have the rate be higher. In principle, you could adjust the rigor. So it's purely a structural choice between the two. It's not how tough versus how flexible do you want, how tough versus how mild do you want the system to be. So anyway, so I think that per country, you could think of per country as just using information, a la the book tax gap, the gap between the tax you paid on this income and the rate you like. And again, not doing a minimum tax structure, but saying that the amount of that shortfall might be relevant to how much tax you're going to charge on it, but without it being like 100% versus 0%. Final takeaways, and I hope I'm not going on too long here. For me, writing this paper was kind of like it started as deja vu all over again, like Frank Drebin is back and just accept it. By the end of thinking about this, a bit in the world of nauseous regurgitation, I was thinking, really, are we really going to have to do all this stuff again, which I regard as being very problematic. More generally, I don't think minimum taxes are really a tool to be very excited about unless optics or politics or whatever is blocking more nuanced and more continuous policy responses. So it's inherently not a great tool, and it's hard to know why you would ever choose it, except for the obvious problem, which is suppose anything else that you're actually able to adopt would be worse, and things that are better you can't adopt. And obviously, we can't rule that out. And finally, when the tax treatment of items depends on the arithmetical relationship between them, for example, how many minimum tax preferences you have versus regular taxable income, the people's liking for a minimum tax structure reflects the semantic appeal of arbitrary discontinuities. You get clientele effects, oddly shifting marginal incentives, and tax planning around the arithmetical relationships between the amount of different types of items. And finally, you may not need the minimum tax structure to use information about relationships between the level of different items where that's actually relevant. So with that, that's my talk.